All right, let's talk about the real world. I mean, the actual physical stuff that our entire global economy is built on. We're talking about commodities, the gold that's probably in the device you're using right now, the oil that fueled the truck that delivered it, and the coffee you might be drinking while you listen. These are the fundamental building blocks of, well, everything. And understanding them can open up a whole new way of thinking about your investments.
But let's get right to the point. The question every single one of us has to ask is this: is my money truly safe? I mean, we all feel it, right? That nagging worry about inflation just chewing away at your savings, or that fear of a sudden market crash taking a huge bite out of your portfolio. It's those very real concerns that push us to look for something different, something beyond the usual stocks and bonds.
Because what if there was a whole class of assets that often zigs when the stock market zags? I mean, think about that. When everything else is going down, these things can actually go up, acting like a shock absorber for your wealth. That's the powerful idea here. And historically, that's exactly the role that commodities have often played. Okay, so here's our game plan. First, we're going to talk about the potential blind spots in your portfolio. Then, we're diving deep into the big three: gold, which is kind of like your portfolio's insurance policy. Then, oil, the engine that powers the whole world. And agriculture, the very foundation of civilization. And we'll wrap it all up with a really important user manual on how to do this right. So let's jump right in. Section 1, your portfolio's blind spots. This is all about the why. Why on earth should you even think about putting raw materials into your investment mix in the first place? First things first, what even is a commodity? Well, it's pretty simple. It's a basic raw material that's standardized. The fancy word is fungible, but all that means is that one unit is pretty much the same as any other. A barrel of oil from this well is the same as a barrel from that well. They're usually split into two big groups: hard commodities, the stuff you dig out of the ground, like gold and oil, and soft commodities, the stuff you grow, like corn and wheat. So, why should you care? Well, there are some pretty compelling reasons. First, they can be an amazing hedge against inflation. Think about it. When the price of everything goes up, what's one of the first things to rise? The price of the raw stuff used to make everything. Second, diversification. Their prices are driven by real-world supply and demand, droughts, discoveries, conflicts, not just CEO decisions or earnings reports. Third, they can act as a geopolitical hedge. When there's instability in the world, assets like oil and gold often perform well. And finally, they're tangible. You can't just press a button and print more gold. These are real assets with real intrinsic value. All right, let's get into our first heavyweight contender. Section 2, gold. We're calling it the insurance policy, and for good reason. For literally thousands of years, whenever fear and uncertainty have taken over, people have instinctively run to gold as a store of value. It's like a financial bedrock. And hey, don't just take my word for it. It's not just regular investors. Get a load of this number: 1,136 tons. That is a record-shattering amount of gold that central banks, we're talking about countries here, bought up recently. When the biggest financial players in the world start trading their paper currency for physical bars of metal, it sends an incredibly powerful message. It says they trust gold as the ultimate safe haven. So what actually makes the price of gold move? Well, fear is a big one for sure, but the real engine under the hood is something called real interest rates. All that means is the interest you'd earn on a super safe government bond minus the rate of inflation. See, gold doesn't pay you any interest to hold it. So when real interest rates are low or even negative, suddenly holding a shiny rock that pays nothing doesn't seem so bad. It becomes way more attractive. A weaker US dollar is also a huge tailwind, since gold is priced in dollars around the world. Okay, so how do you actually buy this stuff? You've basically got three main options. The easiest, the one-click method, is a physical gold ETF. You're buying a share of a fund that owns giant bars of gold in a vault somewhere. It's super simple, but you don't actually own the gold. The second way is to buy gold mining stocks. This is like a leveraged bet. If gold goes up a little, a miner's profits can go up a lot. But you're also betting on that specific company to be well run. And last, there's physical bullion. We're talking actual coins and bars. You own it, you can hold it, but then you've got to figure out where to store it safely. All right, let's shift gears. We've talked about the safe haven. Now let's talk about the fuel for the entire global economic engine. Section 3, oil. The price of oil is basically a real-time report card on the health of the world's economy. It is literally the lifeblood of modern industry. Now, you always hear these two terms on the news, right? WTI and Brent. So what's the difference? It's actually pretty simple.
Think of WTI or West Texas Intermediate as the American price. It's most influenced by what's happening with supply and demand right here in the US. Brent crude, on the other hand, is the global benchmark. It prices something like two-thirds of all the oil traded in the world. And because of that, its price is much more sensitive to what's happening on the international stage.
The oil market is famously, well, wild. And these are the big reasons why. First and foremost, you've got OPEC+. This is the cartel of oil-producing nations that can literally turn a spigot and send prices flying. Then there's global economic growth. When the economy is humming, we use more fuel. It's that simple. Geopolitical events, of course, are huge. A conflict in a major oil region can cause massive supply fears. And finally, something the pros watch like a hawk. The weekly U.S. inventory reports. A surprise dip in our stockpiles can send prices jumping in a matter of minutes.
So, how do you invest in oil? Now, this gets a little more complex than gold. You can buy a futures-based ETF that tries to track the price of oil directly, but these are pretty tricky instruments with unique risks we're about to cover, and they can make your taxes a headache. A much more common route for most people is to buy an energy stock ETF. This holds a whole basket of big oil companies. Or, of course, you can just buy the stocks of those major producers directly, and they often pay you a nice dividend just for holding them. All right, moving on to Section 4. We've talked about what's under the grounds. Now let's talk about what grows on it. We're talking agriculture. And investing here, it's not really about next season's crop. It's a long-term bet on one of the most powerful and predictable trends on the planet, a growing global population. And this is where things get really fascinating, how all these markets are connected. Check this out. A whopping 40% of the entire U.S. corn crop doesn't end up as food for people or animals. Nope. It gets turned into ethanol to be blended into our gasoline. So suddenly, the price of corn isn't just about food. It's directly tied to government energy policy and what you pay at the pump. It's a total game changer for that market. When it comes to the price of corn, wheat, or soybeans, there is one driver that rules them all: the weather. Mother Nature is the CEO, period. A single unexpected drought can send prices to the moon. After that, traders are glued to the official USDA reports, which give the official data on supply and demand. And then you have these huge macro forces like rising demand from a growing middle class around the world, and short-term political moves like tariffs or biofuel mandates. So what are your options here? Well, you can buy a broad agriculture ETF that holds a basket of different crop futures. It's a diversified approach. Or you could take a different angle and buy agribusiness stocks. You're not betting on the price of corn, you're betting on the companies that sell tractors or process the grain. And finally, there's a really cool one: farmland REITs. You are literally investing in the land itself, becoming a landlord to farmers and collecting rent. It's a pretty direct way to invest in the one thing they're not making any more of. Okay, we've covered a lot of ground, from gold vaults to oil fields to cornfields. But now we've reached what is maybe the most important part of this whole discussion. Section 5, the Investor's User Manual. This is where we talk about the real risks and how to be smart about all this. Okay, I need you to lean in for this one because this concept is absolutely critical, and it can be a real portfolio killer if you don't get it. It's called contango. Many commodity ETFs, especially for oil and ag, don't hold the physical stuff. They use futures contracts. Contango happens when the price of the next month's contract is higher than the current one. This means the fund is constantly forced to sell its cheaper, expiring contract and buy the next, more expensive one. It's a forced sell low, buy high every single month, and that small drag can just grind away your returns over time. It's a silent killer. So let's put all the big risks on the table. First, you've got extreme volatility. You have to be prepared for some wild price swings. Second, that hidden drag of contango we just talked about, it can be a massive deal. Third, there's no income. A bar of gold or a barrel of oil doesn't pay you a dividend. Your only hope for a return is if the price goes up. And finally, this stuff can be complex. You've really got to do your homework and understand what you're buying, especially with those futures-based funds. So how do you use these powerful tools without getting burned? A few simple rules. 1, think of them as a tool, not the whole toolbox. They are seasoning for your portfolio, not the main course. 2, start small. A small allocation, somewhere in the 3 to 7% range, is a very common way to get some diversification benefits without taking on massive risk. And 3, choose your vehicle wisely. The right answer for you depends completely on your own goals. Are you a simple ETF person, a stock picker, or someone who wants to hold the physical asset?
I'm going to leave you with this fantastic quote from the legendary investor Jim Rogers, because it just flips everything we think we know about investing on its head. See, with a stock, you look at the company's fundamentals, its earnings, its sales, and that helps determine the price. In commodities, a huge price spike, maybe from a war or a drought, becomes the new fundamental reality that forces everyone else to change. The price creates the story, not the other way around. It's a totally different mindset. And that pretty much brings us to the end. We've looked at gold as your insurance plan, oil as the engine of the economy, and agriculture as a bet on the future of humanity. We've also been really clear about the risks and the smart ways to approach this. So the final question really is for you. Now that you know the options out there, is there a tool here that might be missing from your own portfolio? Thanks for listening.